All right, so kicking off the agenda for today is I'm just going to give you a couple of reminders, and then we're going to talk about really there's not a lot of change or things that you really need to know for June 25 this year. But after that, I'm going to jump through and give you some high-level information around what's coming over the next few years, particularly around a new IFRS 18, which replaces AASB 101. So it's a replacement of, in effect, the foundational standard, a foundational accounting standard. I'll briefly touch on sustainability reporting. It won't be a full session on that. It's big. But talk through some practical implications about just to remind you of timeframes and where we're at with that. I'll then work through special purpose and tier 3, which is about the removal of special purpose reporting in the not-for-profit space and what the AASB has done there, and talk briefly about control and consolidation, and then just some concluding matters and a few things that are further out on the agenda, but things the AASB is looking at. So hopefully we'll just work through these in a relatively systematic way. I will try not to speak too fast because that is the common feedback. So I apologise in advance if I get a roll on. But other than that, we'll kick off and jump into the changes for the current year. And so really they're reminders. The biggest one is in relation to AASB 101, which again, that's the foundational standard, talks about what financial statements should look like and the core requirements around accounting sit within AASB 101. So the biggest change there is in relation to the classification of liabilities and what's non-current versus current. So the changes, there was a changing standard being 2020-1 and 2020-6. So effective for periods commencing 1 January 2023, but that sounds like a long time ago. That means for December 24s, it's happened, but for June 25, it's really the first year. We are aware that there's a number of organisations who've early adopted, however, because it makes a little bit of sense for them. The key part of the change is it removes the unconditional word out of the definition of liabilities. They were current unless you previously had what was called an unconditional legal right to defer. And then they could be non-current. That word unconditional has been removed from the wording. And what that means is that you no longer need an unconditional right. In Australia, this had some unique consequences because our banks and the banking arrangements often had sort of annual review type clauses and included ability for banks particularly to change payments, alter your principal amount, reevaluate the loan if they saw specific risk in a sector or were clamping down on their LVRs, for example. And so what that meant is if you had those sort of clauses in your arrangements, you really had to record those debts as current. With the removal of that, we're likely to see more non-current bank debt, particularly where you have multi-year facility. So if you have multi-year facility, it's far more likely that you'll be able to report those as non-current going forward. I do note that the other major change was really in relation to clarifying examples around if you've got covenants and covenant breaches. And so what that did, and I'll bring up the disclosure requirement, there's some, the requirements really remain the same. If you have breached a covenant at balance date, and that has not been in effect waived by the bank by balance date, your debt will be, as at balance date, will be current because you don't have legal right to defer. The bank has rights to, in effect, probably call in that loan or whatever rights they have under a breach of covenant arrangement. So if that's the case, I just remind you as well around the disclosure requirements. If you have a covenant breach not waived, it's still going to be current under AASB 101. If you're a tier 2 or simplified disclosure reporter, there's a number of disclosure requirements, or these are the new disclosure requirements. You have to include information about covenants within your disclosures, including the current carrying amount of any liabilities. What that means is typically under the bank liabilities or borrowings note, we typically have some details around the facility, so how many years it is, for example, but also that should include if you have any covenants. And if you have facts and circumstances where you might have difficulty complying with those covenants, and there's some examples, there's also a disclosure around some of those facts and circumstances required under AASB 1060. So that's the simplified disclosure standard. If you're doing full, in effect, IFRS or full compliance with all accounting standards, the disclosure requirements in AASB 101 are the same, but there's also additional ones as well within AASB 101 if you have those major, that full disclosure requirement. So that's probably the biggest change. I'd also like to take the opportunity just to remind you around leases. This is probably an area where we see a lot of audit adjustments, a lot of difficulty, where we actually provide a lot of assistance to clients around calculations. But just a reminder that AASB 16, it actually is quite a complex standard, particularly where there's any changes in leases, renewal of leases, amendment of lease agreements. You have to be really careful whether that represents, in effect, a new lease or it's a lease modification that's accounted for as under an existing calculation, or you do an entire new calculation. And so just a really common example of that is where you enter into a new lease for the same property you currently occupy. That is actually a lease modification, not a new lease. And so it means that the practical outcome of that is you record your right of use asset, lease liability at the date you entered into that lease, where if it was a new lease rather than a lease modification, you would not record anything until the commencement date of the lease. And so there's some real nuance. That's just an example of some of the nuance in AASB 16. So if you have multiple leases, those have changed or new lease agreements, please just be careful the way you account for those. And if necessary, just reach out to your auditor, someone in the audit team here, and we'll be able to just point you in the right direction of what the appropriate accounting treatment would be. So outside of those few things, there really is no significant changes to financial reporting, particularly for organisations that I understand would be on this call. There's always some IFRIC, international sort of interpretation decisions and things like that. But I've gone through all those, and I think there's very limited application to clients that I think and others that would enter onto this call. So I won't go through those today. So the next thing I want to talk about is new standards. And so IFRS 18, again, I'm aware that there's probably a lot of not-for-profits on the call. These items that I've put at the start of this presentation are really both apply to NFPs as well as the for-profit space. Once I get into the NFP particular space, I'll let you know. So if you're a for-profit and you have no involvement in NFPs and not interested, I'll let you know and you can jump off the call early. So IFRS 18 is quite a big change. What it does, it's going to basically replace AASB 101. Like I said before, it is the foundational standard of the accounting standards. And it introduces some new concepts, particularly in the one that you will be most obvious. The most obvious change when it gets implemented is the structure of the profit and loss. And what it requires is, and I'll put up an example, is really a change of format. And so it looks significantly different to what the standard format looks like now. In addition to that, there's additional disclosures around financial statement, profit and loss performance measures. Typically, we see these more at the larger end of town, so listed entities who really report a lot on something like EBITDA or some other type of defined performance measure. And there's a whole lot of disclosures and information required around that and requires consistency of application. And there's also some additional principles around aggregation and disaggregation in the primary financial statements and the notes around various balances and whether you can join them together or have to separate them out for disclosure requirements. I won't go through all those second bits of detail, so bullet points 2 and 3 there, but I will show you what an income statement looks like and talk to you a little bit about that. This standard will apply from 1 January 2027. So that's periods beginning on or after 1 Jan. NFPs will be a year later. We saw that when 15 and 6, so revenue standard, LISA standard came in. There was a bit of delayed step for those organisations, so that you've got an extra year on that. So this is an extract I've copied it out of one of the large accounting firms put out. This is what the new standard will look like. And so if you look to the left-hand side of this slide, you'll see that the P&L will be divided up into operating, investing, and financing. Looks a lot like a cash flow disaggregation, but it's a little bit different. So up within operating, we'll still have all your main sources of revenue. Your expenses, it's on one line here. It won't be that. It will be broken down similar to what you have now, either by nature or function. So you might have wages and depreciation, administration, costs of goods sold, etc. So they'll actually be broken out similar to what they are now. You'll then have what's called investing activities. So that's really any movement in fair value movements in investment portfolios, dividend, interest income, those type of things, or things with that nature. And then you've got financing down as the third category, which is really your borrowing costs, including from leases. So that calculated or notional interest portion of a lease payment would also go down there. So really, you come down with an operating profit, then what's your P&L from investing activities, and then the interest. So that's sort of an EBIT type number, and then you have an interest and tax type number further down. You can still use, for not-for-profits, you can still use surplus deficit, things like that. So these wordings are not prescribed, but the format will be looking far more like this. But hopefully that makes a bit of sense. I think it's, I don't think it's got problems per se. I would note some differences. So although it looks like a cash flow, then the nature of the items that are included in the different categories are not the same. So investing in the P&L is income from investments, or I guess it could be a loss in fair value as well, or an expense. So it's income from investments. However, you'll know that your investing in a cash flow statement actually includes your acquisition of PPE as well. Whereas in the P&L, your depreciation expense in relation to that PPE is up in the operating category. So it's not a category. So not a you can't compare cash flow items that are categorized under those categories will be different to P&L items within those categories. So it's not a replica of the cash flow, but it does use the same headings. I would note that this standard does have a lot of complexity in it that I'm not going to go through today because we've got some time, obviously. So where the entity has complexity, AASB 18 or IFRS 18 also has complexity to deal with that. So if you're not a complex organisation, outside of those P&L adjustments format, you probably won't see a lot. If you have a lot of complexity within your organisation, though, you might see a bit more, and we'll go through that in future periods in the lead up to the introduction of IFRS 18. For those of you which would be the majority, I think, would either still be doing special purpose in the not-for-profit space, or you're doing tier 2 or simplified disclosure. The amendments that are being made to AASB 1060, which is the simplified disclosure standard for general purpose reporting, those amendments have not been completed yet and haven't been exposed or put out for comment. And so the AASB is working on how will IFRS 18 be adopted from a simplified disclosure perspective, and therefore how does AASB 1060 change? Because those changes haven't been adopted, I would note that you cannot early adopt IFRS 18 yet. So if you're an SDS or Tier 2 reporter, IFRS 18 is not yet available for early adoption for you. It's probably a little bit early anyway, but we think we'll have a number of particularly not-for-profit clients who will quite like that disaggregation and the separation of investing and interest, particularly investing lines, from what they consider the operating lines. So we actually expect that we'll get a fair bit of early uptake, or at least inquire around can I and when should I early adopt this standard. So at the moment, hold fire. I would expect that it would be available in 12 months' time. So by the time we get to June 26, I would think that the SDS disclosure requirements will be there, and therefore you can early adopt. Right, moving on to sustainability. This is very high level what I want to talk about today. It's really just a reminder for you if you're caught by sustainability, or give you some understanding if you're not, and those requirements, as opposed to detail, here's how carbon accounting works, etc. So when I talk about sustainability reporting, please understand that in Australia, sustainability reporting that's coming is really about greenhouse gas emissions, carbon accounting, those sort of things. It's not about rewilding, biodiversity, any of those other sort of sustainability type things that you would talk about, or you would think about when we say sustainability from a more holistic perspective. It really is about carbon emissions, or greenhouse gas emissions. So he needs to report. So it's for anyone who currently reports under Chapter 2M of the Corporations Act. That really means, I would think on this call, so I don't know that we would have any, but listed companies, and then right down to large proprietary limited for-profit entities. I've got some exemptions on the next slide, but if you're a charity listening on, you would, an ACNC registered charity, you are exempt from these requirements. If you're a Corporations Act charity, so where you're in effect self-assessing, tax exemption, for example, be it a peak body, a sporting organisation, or a peak body where mutuality applies from a taxation perspective, you are reporting under Chapter 2M. And so if you fall into the requirements, you will also be caught. I'd note that that's a pretty large threshold. So if you look down the requirements, it's 2 or more of the following thresholds. So on the far right-hand side, we're talking about Tier 1's 500 million revenue, Tier 2's over 200 million revenue, / more than 250 employees, or more than 500 million of assets. But the third threshold is where I think we may have some people on the call, or the third group, sorry, which is really the large proprietary limited threshold at the moment. So greater than 50 million in revenue, greater than 25 million in total assets, not net assets, total assets, and more than 100 employees. If you meet 2 of those, you're a large proprietary limited entity, or you're a large entity from a Corps Act perspective already. And so sustainability reporting will apply to you from 1 July 2027. I haven't put up the slides today. There's a staggered level of reporting that you need to do. You don't need to do everything at once. And there's a staggered level of assurance that gets given over those over the sustainability report. And that comes in over a couple of years. And so there is a bit of it's not all in all at once, but there's a bit to do if you're in that third group. I'll talk a little bit about what it looks like in a minute. So who doesn't need to report? So if you're exempt from lodging financial reports under Chapter 2M, think you're an ACNC registered charity, you're a self-assessing charity, but you're an incorporated association, or a not-for-profit that's incorporated association. So even if you're not ACNC, you don't report under Chapter 2M. Likewise, if you're exempt under a number of asset class orders, provide exemption relief for financial reporting / audit. If you have those exemptions, they carry over into sustainability. I also note that there's a Group 3 materiality exemption, where if you can determine that you have no material climate risk and opportunities, you still need to prepare a report, but really it's a report that discloses a statement and explains why you don't have those material risks. And therefore, you then wouldn't have to go through all the steps of reporting. I would note that that statement explaining why will need some robustness about it and also needs auditor sign off. And so you need to convince your auditor that you don't have material climate risks. I would note that at this stage, there remains uncertainty around how that materiality applies and what needs to be considered to fall inside or outside of no material climate risk opportunities. So that's still being considered, guidance is being put out, but really the accounting profession and others are really working their way through what that exemption might look like and who it would apply to. But there's some thought that it could apply to it's not going to be a very few. It's quite likely that there'll be a large number of particularly Group 3s that may apply to. So just from a high level, sustainability reporting, what does it include? It includes climate statements around risks, around controls and risk management, both from a governance and a strategy perspective, and includes some data or metrics around and targets around what's called Scope 1, 2, and 3 emissions. Scope 1 and 2 emissions are really the emissions that are within your control, so either direct burning of fossil fuels, etc. So if you have gas, use gas in your facilities, or you have a car fleet or a vehicle fleet that obviously that are petrol / diesel cars, etc. You have Scope 1 emissions. Scope 2 emissions are really your electricity use. Scope 3 emissions are your upstream and downstream emissions of your supply chain and everything else. So there's measurement basis for carbon accounting around that. The statements will also include various notes around how you've your accounting policies are very similar to those, and a declaration. So if you are within Group 3, or if you're in a higher group than that, you really need to start to think about particularly climate-related risks. So if the global temperatures move by 2 degrees, for example, what are the risks and opportunities for your organisation because of that? So that's really the type of risk approach you need to think about, and then start documenting how you, from a governance perspective, what are you doing and considering around sustainability, same from a strategy perspective, and really start to think about gathering various information, particularly for Scope 1 and 2 emissions, which are the first part of reporting. I don't intend to go into more detail, but I would note a few things that as at 31 December this year, the first listed entities will be reporting. So if there's organisations that are listed that do similar things to you, but presumably on a bigger scale, you'll be able to get some really good insight around what they're doing. So don't pick up BHP report and go and try and work out, what does this mean for me for sustainability reporting? Find an organisation that is a bit more, has single sort of really core business functions that perhaps aren't mining and those sort of things, and you'll be able to get a real feel for, well, practically what's this going to look like, etc. There'll be a lot more out there come December 25. I would note that the Ethical Standards Board and the Auditing Standards Board are still working on the requirements for auditors and the ethics requirements. And so this is really, it continues to be an evolving space. The AUASB, in case some of you sort of follow this stuff, they have put out first round of guidance, but I think they're revisiting some of it and trying to clarify some of it. And that's what I mean by still working on it. The Ethics Board has really just released ethical standards around independence, etc., very recently. So I would note also that if you're sitting back thinking, I can just get my auditor to do all these calculations and prepare that report for me, that will be very difficult for your auditor, in that the principle of auditing your own work will still apply. So an auditor can't come in and in effect step into the shoes of management and do a lot of this work for you and then audit it. So you will either need to upskill. They certainly can give you some education, point you in the right directions, and auditors we're certainly here to help. But if you really want to outsource the work or required to because you don't even have the time or the skill set to get up and the time to get up to speed with this skill set, then you'll probably need to get someone external to your auditor to give you some assistance in relation to detailed calculations and reporting. So that's a reminder. All right, I will pause for a moment and just so that is the for-profit stuff, as well as obviously there's a lot chunk of this applies to not-for-profits as well. The rest is really about the not-for-profit space. So sort of we're halfway through. So if you're a for-profit and have no interest or involvement in NFPs, thanks for attending. Please feel free to exit this webinar. All right, let's wait for that for a sec. All right, I'm now going to talk about special purpose and tier 3. Many of you may have heard me talk about special purpose and it being removed for a long time. And I'm going to continue to talk about it for a couple more years yet. So what has happened? So special purpose, I note the very bottom line, special purpose was removed as a reporting concept for for-profits reporting on the public record. So in effect, lodging with ASIC or another regulator. Removed in 2021. So it's been gone for a fair while. The AASB then turned their minds purely to the NFP space. So this project commenced back in 2015. There was a discussion paper around tier 3, and I'll talk a lot about tier 3 in the next bit in August 22. We now have exposure draft standards released that propose the removal of special purpose and what the tier 3 standard will look like. That happened in October 24, not October 25. And the final standard is expected to be released in the first half of next year. So I don't think it'll be exposed again. It will just be an effective standard depending on the scope paragraphs around dates, but it will come out as a standard in the first half of the next year. And what that means is that standard will likely be effective either at 1 July 28 or 1 July 2029, or maybe January in the middle of those periods. That is the expected time frame around the removal of special purpose. So delving a little bit further into the details around that. So tier 3 is what was proposed because of the issues around the complexity of tier 2, or the full accounting standard suite, if you like, on smaller not-for-profits. So the tier 3 objectives were to reduce the reporting burden on smaller NFP, private sector NFPs. That public sector NFPs is government, so private sector NFPs is what that means. Where existing tier 1 or tier 2, being the full accounting standards we have now, requirements are overly complex and the cost benefit isn't there. So just to say from the outset, I think the AASB has been very pragmatic and actually done a really good job at working their way through tier 3. So I think there's a lot of people involved at the Accounting Standards Board and people who give input into the Accounting Standards Board who probably fit into the bit of the accounting standards geeks category, which many people say I'm in that category also. And a number of them have very philosophical views on how accounting should be done. And so to move from those philosophical views to something that's really quite pragmatic and very broad in its application, I think was something that again, I'll just say has been really well done by the AASB. So the new exposure drafts released were 334 and 335. If you want to go back and have a look at them, the first 334 is in effect all the requirements to remove the option for special purpose out of all the accounting standards as it exists at the moment. And 335 is the new standard, which is for tier 3. So it's a single standard designed for smaller private sector NFPs. So the big question is, well, who gets to apply tier 3? And the answer to that at the moment is we're not sure. So it is a regulator decision. The AASB will not set a threshold within the accounting standard. What we will see is Treasury for both the ACNC and Corporations Act will presumably set a threshold. The states in relation to incorporated associations will also set a threshold. Hopefully they're the same threshold, but who knows? Around who gets to apply Tier 3. It's likely to be a revenue threshold because that's what the ACNC and Corps Act use at the moment, so do most states. The standard was designed for organisations with less than $3 million in turnover or revenue. So when the standard was being designed, and I've been involved in that project with the AASB for the last 4 years or so, as the standard got designed, the obvious question was, well, who's going to apply this standard? Because what the rules should be, if you like, would change depending on how large or complex an organisation is. And so they set it at the medium charity threshold, in effect, for want of having something to develop a standard by. So I would say, who's it going to apply to? If you're on this call and you have less than 3 million turnover, highly likely you would be able to apply Tier 3. If you're between 3 and 5, or maybe 3 and 10 million turnover, I would say possible that you might get to apply Tier 3. If you're over 10, I would say probably unlikely. Personally, I think it could be a higher threshold, like that's what we'd advocate for. We actually think it's a relatively good standard that could be easily used and not be inappropriate for a higher threshold. However, views on this are all over the map. So we have people thinking that it should only be 3, others saying 5. So Chartered Accountants, CANZ, came out and said it should be 5. They didn't have any real basis for why it was 5 and not 3 and not 10. But that's what they said in their submission. But so it's unclear. So if you're a special purpose or preparing special purpose reports and you're less than 10 million, if you ask me, what should I do? Should I do anything about this at the moment? I would say no. Continue to do exactly what you're doing around special purpose if it's still appropriate for your reporting, which I think the majority of cases that would still yes, unless something significant has changed for your organisation, that would still be yes. Continue to do that. As thresholds become clear, you'll then understand which way and what options you have far more clearly. So in effect, hang out where you are for another year or so. And by this time next year, hopefully we'll have some real clarity around both Tier 3, the standard, but hopefully some more clarity around what the regulators are doing, or Treasury in effect is doing around thresholds and therefore who can apply Tier 3. All right, walking through some of the key changes of Tier 3, what does it look like based on the exposure drafts? Again, I've been in a number of meetings with the AASB since the exposure drafts, listening and heard the feedback. So I'm pretty confident around some things not changing and other things that are probably still being considered. So I just want to highlight those. So these slides, the grey boxes are extracts from the AASB around a summary of the standard. So you can go and look that up and read these with a bit of analysis on the side from me. Where it says R&M, that means recognition and measurement requirements on the slide. So how do I record my transactions and balances? So mostly I've focused on recognition and measurement requirements, not disclosure requirements. So that's what that means. So walking my way through the biggest changes, the first one is in relation to related parties and consolidation. So the Tier 3 standard in effect reduces and doesn't put in the complexity around what's an entity that's controlled, where do you have significant influence, etc., which is quite difficult to interpret in a lot of not-for-profit contexts. And you'll note I've got some more slides on this later on. I think that standard needs consideration, and it is up for consideration, but I'm not quite sure how much change we can expect there. And so what the Tier 3 standard does, it introduces this concept of what's a notable relationship. So where you've got something like a subsidiary or an associate or something that's an organisation you have a very close relationship with, that's likely to be one of those, you can just not go through the formality of trying to assess and just say, well, these are our notable relationships where you have significant influence or someone else has at least significant influence over you. And the reason you can do that is because consolidation is going to be a choice. So if you don't have to work out whether you control another entity or you're controlled by another entity, you can't then work out whether you need to consolidate or not. And so consolidation is a choice. And so I think we'll see organisations really step back and say, well, who are these financial statements for? Does it make sense to put these entities together, or does it make sense to report them separately? And so hopefully that's the basis of that choice. Is really should be a user one. If you go down the path of actually, I want to prepare consolidated financials reports, so add some entities together or add yourself and a subsidiary entity together, you do need to think about the control consolidation procedures and assessment, which is the same as what Tier 2 will be. So it's extracted out of Tier 2 at the moment, which is the AASB 10 requirements. So that's consolidation. So I think that's a really good outcome. One of the things in the standard where it talked about a business combination, so where you perhaps merge with an entity, take over another entity, purchase another entity, it put in this concept of what was a deemed acquisition date. This came out of the blue. Really, it hadn't been discussed at any of the forums. I think they got some feedback that it's sometimes really difficult, and this is true, that sometimes very difficult to determine when exactly control occurs as two entities sort of start to work together until they finally merge. When is that control from an accounting standard perspective? So they thought up this deemed combination date, which was the earliest the start of the period. But that had some issues in our view. Firstly, being that it doesn't really make sense to, if you're going to consolidate entities, to put all these transactions in from the start of the period when you may have had nothing to do with that entity until the middle of the period, for example. And so I think that concept of deemed combination is likely to change based on my discussions with the AASB since that. I would note of particular interest is if you acquire another organisation / merge with it, you would be used to seeing either a discount on acquisition entry in the P&L or goodwill potentially. Under Tier 3, there is no goodwill. You do an entry to equity. So you merge two, and nor is there any P&L impact. And so the difference between the net assets or the net assets that you in effect acquire if you purchase an entity, or the net assets that an entity has if you merge with it, that's just an entry directly to equity. So you'll take up in effect the balance sheet as at that acquisition date or the best estimate of it. And the other side of that entry just goes to some sort of equity, either a reserve or some sort of other equity account at that point. So no P&L impact on merger acquisition of an entity, and no goodwill in relation to it either. Last one on related party disclosures in this space. So there's been a fair bit of talk about related parties. We've seen me presented on it before, particularly as the related party disclosures became mandatory for ACNC charities a couple of years ago. Tier 3 doesn't require disclosure of KMP or key management personnel, doesn't require disclosure of donations from related parties, so particularly donations from directors and that sort of thing, unless the donations could influence the entity's activities or resources. So that is so really responding to the issues that came about because of the ACNC mandatory reporting of it. I would note that the other requirements are consistent with Tier 2 around related parties, but the language used in the standard, like across the standard as a whole, but also in this area, have been simplified, and they have less detail. Accounting policies and errors. So when if you're a Tier 3 reporter or get into Tier 3 and you make a change to an accounting policy, or there's a new standard which changes the accounting policy, you don't go back and change the prior year comparative. You do in effect an opening balance equity adjustment and disclose those changes. That's been common where there's been transitional relief around when new standards come in and those sort of things, where it's really difficult to go backwards. I would note that the Tier 3 proposals currently say the same if you've got an error. This is potentially being reconsidered by the AASB. there is a disclosure, there's a whole lot of disclosure requirements. So the bit in orange is what we've said back to the AASB in our submission on this tier 3. And that was, if you really need to, if you have to quantify the error and post an opening balance adjustment into equity and disclose the nature of the error, in our view, you might as well just go back and change the comparative. And we think that gives better financial reporting and more representative financial reporting. And so it's not just us saying that. There's a bit of a split in the feedback received by the AASB around this space. And so that one may change, but at the moment it's drafted with no comparative adjustment. But it's possible that, as I said, the AASB may change that. All right, moving through to a couple of the really big items, which I think will make most people on this call quite happy with where it's landed. First one's around revenue recognition. So rather than the, do I have an enforceable agreement? What are my performance conditions or performance obligations under AASB 15? How then should I recognise revenue? It's as benefit is transferred to the client or the customer, which is really complex and has to be an assessment has to be made in effect grant by grant or revenue stream by revenue stream. They've really simplified revenue recognition. And now revenue can be recognised based on where the entity and the provider of the funds or the donor or the grantor, if you like, have a common understanding of what the entity is to perform and in a particular manner. Then if you have that, revenue will be deferred until you satisfy or in a pattern that faithfully represents the consumption of the resource received, or as the services are performed, or as the money's spent. And so we end up at far more back at the matching type principle or concept, which the standards have moved away from for a long time. What that means is I think you'll be able to structure arrangements really well with your funders. So at the moment, if you have, get money through a website, I think if the donor was required to click, it's for this, this, and this, or it's for this particular project or this particular even year. So it's funding this X within the organisation for the 25-26 year. That would be enough for common understanding, in my view, because that would be communication from the donor/grantor. And you would then be able to, in effect, defer your revenue into the following period or into the period it relates to. So I think there's going to be a real opportunity to have a think about what sort of revenue recognition makes sense for you, and then structure your arrangements either through your website or through other communication. As an auditor, I'm going to be after some written stuff, not just you telling me that there was this verbal arrangement. Otherwise, we'll seek to confirm the verbal arrangement. But I think there's some really clear ability to move towards matching, and that's going to make the sector broadly far happier, I think, than where we currently are at. So we put some submissions in and around this. So like we said, we think there'll be far more significant amounts of revenue deferred, and have said, it'd be great if you could give some examples around, we're raising money for a natural disaster, for example. However, there's a where most needed clause, and what happens when funds get repurposed, etc., under those sort of arrangements. It'd be great for the AASB to unpack a common example like that. So that was part of our submission. The next one, leases, lease accounting, a bit back to the future, in case you're too young to realise who those people on the right-hand side are. But we really go leases back off the balance sheet. So no right of use asset / lease liability for in effect for operating or any sort of lease arrangements, and you'll simply expense your lease payments, or if you're the lessor, you'll recognise your lease revenue over, in effect, a straight line / systematic pattern. So all the complexity of lease accounting, even some of the stuff that I mentioned earlier on, will disappear for tier 3. I think I can hear you all cheering if you weren't all on mute. And I agree. So that's a big concession, a good concession in my view. PPE, so property, plant and equipment. the requirements are largely consistent. I do note a couple of things that if you're doing a property development or things like that and you've borrowed for it, we quite often see capitalisation, or from time to time see capitalisation of borrowing costs. You cannot do that under Tier 3. Interest expense is an expense. Likewise, something else that's different if you receive donated property. So someone gives you a house or a car, piece of artwork, I don't know, something else of value. You have a choice. So you can, there is no longer a requirement that that would be at fair value. So it can be, but it also could be recorded at its cost, which may be zero or very close to zero. And so that's quite a significant change. Whereas if you received got donated a house, for example, piece of land, the current requirements is you need to go fair value that and book that income. So probably recording a bit less income. I'm not too sure about this one, but that's the AASB's landed there on this one. So yeah, a bit less revenue being recorded if you elect to choose cost. I think for those of you running op shops or things like that, you really already had the opportunity to record cost because the materiality was assessed on a transaction by transaction or donation by donation concept. But this continues to open the door for that type of concession around inventory type donations. In relation to impairment, often the calculations for impairment are tricky in a not-for-profit space. It's sort of depreciated replacement cost. What's my recoverable amount? Do I have to do a cash flow? Those sort of things. AASB said that's all too hard. Doesn't really fit for NFPs well. So now there's some practical indicators of impairment. If it's physically damaged, the service potential or its use has changed, particularly because of external demands, then that's an indicator of impairment, in which case go work out what its fair value less cost to sell is, or / its value in use, and then write it down accordingly. If you don't have those indicators, you don't have to do tests for impairment, despite you might be making a loss, or you might not, its recoverable amount is a bit less certain. But without that, you get to continue to carry it on, continue to book it and depreciate it if necessary. Intangible assets. So think IP, websites, things like that. If it's internally generated, you expense. If regardless of the useful life, it makes you the maximum useful life you can apply to an intangible will be 10 years, and then you will amortize / depreciate over that period. So if you have goodwill on your balance sheet at the moment, you will be required to amortize that down over a 10-year period. Likewise, any other sort of IP. What the standard didn't address was software as a service, sort of cloud computing arrangements. At the moment, they're really required to be expensed unless you have control over the code and in effect own the code and the underlying asset. So that's likely to continue. So unless you have that, you will be expensing those type of intangibles under Tier 3. I know that's not necessarily always done for special purpose. The good thing is you have 2 or 3 years before this applies. By that period, most of those types of assets will be amortized anyway. However, if you're entering into those type arrangements and trying to capitalize those costs onto your balance sheet as a special purpose reporter, just beware that they might be written off on transition or written down on transition if you haven't incurred those costs yet once Tier 3 applies. So they're the core changes of Tier 3. The big question in the room, I guess, or the big other question is, well, if I'm above Tier 3 and I'm a special purpose reporter, so you don't meet the threshold, whatever that ends up being, what does that mean? It means you're in Tier 2, and that means you're in the complexity of revenue, leases, consolidation, simplified disclosure requirements. So from our perspective, you should start to, particularly if you're over 10 million in revenue and therefore you're highly likely to be in tier two, you should start to think about those requirements and what they may mean for you. It means that you probably, with some confidence, could start to think about moving towards general purpose earlier. You don't have to wait until you can't do special purpose anymore if it's highly likely you're going to, that's about to be, would be removed. Personally, I'd say, you may as well continue on special purpose for another year. But if as soon as thresholds become clear, you can think about moving. And when is a good time to move? So when you've got resources, those sort of things. If you think about doing major expansion or entering into transactions which would be recorded differently and under GP, maybe you move early. I do want to touch on, and this is the last main thing, is control and consolidation. And the removal and the implications of the removal of special purpose around that. So this is something that's been on the AASB agenda. It's something we've been talking to AASB about for a long time, particularly trying to represent our clients within the NFP space. We have a lot of clients which have structures with multiple entities in them where control is difficult to determine. So it's really common in the sort of the religious space, but is also common in other parts of the sector. So there's the AASB did a post-implementation review of AASB 10, which is the consolidation standard. The board met around that. There isn't really an overwhelming response. There was actually really limited response. We expressed concerns in that. We did a formal submission. There wasn't a lot of others. Some people are saying there's nothing wrong with consolidation and the requirements of AASB 10 at the moment. We're saying we think you need to change it. So the AASB sort of just sat on the fence a bit longer, and they've said they're going to conduct ongoing research into NFP and consolidation. Now, I understand that actually does mean they will do some research and not do nothing, but the opportunity for this standard to be, in my view, corrected or fixed or improved, the door on this is going to close over the next 12 months or so, I think. And so if you have concerns, you've talked to me about it before, I would please watch that space on the AASB. Though I think the AASB would really like it if entities that have genuine impact of this, where consolidation just doesn't make sense, if you gave feedback, I think that's the best chance for change, as well as accounting firms like us, etc. So why are we talking about this? Well, definition of control and in the NFP concept is based on power to control. Typically, this is via the membership. So either you're the sole membership or the sole member of an organisation. Your organisation might be the sole member, or in effect, your board is the board of another organisation, and that's just fixed in the constitution, and they're the members. That sort of control or basis of control. The other one is the ability to appoint the majority of the board. So they're not the only ways we get to control, but they're probably the two most common ways within the NFP space. Within AASB 10, there's also other limbs, what's called limbs around. Not only do you need control, but you need to show variable returns and your ability to impact them. In my view, that definition of returns is so broad in the not-for-profit guidance that it's really about, do you further your purpose or further your objectives by having this control? I find it difficult to see if you have a charitable purpose, and within that charitable purpose, you're either exercising your responsibilities as member or appointing the majority of the board, how you could then say that's not a furtherance of your objectives or your purposes. Because if it wasn't, you probably shouldn't be doing it. So I think you get caught under those, and therefore it really comes back to the control test. And so if consolidation just doesn't make sense to you, and typically we say it doesn't make sense where you have a user group for your accounts and a separate user group for maybe a subsidiary's account. And a classic example is you sort of have a church and a school, for example. The users of the church accounts might be the members of the congregation or the members of a church. The users of the school accounts are the regulator and the parents of the kids, etc. And they may be two very separate user groups. Putting these two sets of accounts together, in our view, doesn't really make sense to anyone. So if that's the case, as that's an example, what could you think about doing if the control standard or the standard around consolidation doesn't change? We think you can start thinking about a couple of options. The first one is where you have this membership of the board or ability to appoint the majority of a board. So where you have the ability to appoint a majority of a board, you typically get control. However, one of the examples in the standard says where you only have veto rights, not the ability to appoint, you would reduce below a threshold, and at that point you wouldn't have control. So if, for example, you could currently appoint all 6 members of a board, you probably have control. Whereas if you said actually and change the constitution, thought about amending the constitution where you now have, for example, criteria for board members. So for example, in my church school example, e.g. the board members have to be a member of the church. The chair of the board of the church is the church's representative on the school board, and we reserve a veto right to, in effect, to appoint the other in relation to the other 4 members. You're probably not at control at that point. And so you could think about can you achieve the objectives that you originally set out to achieve by having control over the board members? Can you still achieve those same objectives with what might be less control? So that's something worth thinking about. Obviously, changes in constitutions take some time, so just going to put some options out there for you. The other one is really around where you have a member, you're the member / the equivalent of a shareholder of a subsidiary. You could think about structure and think about a structure where you have a parent entity, so either restructure your group, interpose a parent entity, something like that, that doesn't have reporting obligations. For example, that could be a non-AC&C charity. It could be a basic religious charity which doesn't have reporting obligations. It could be a tier 3 entity, so you don't meet the tier 3 threshold and therefore you don't have to consolidate. And so what that means is you end up as a structure that looks something like this, where it's a bit flat. Again, I'm not out there trying to advocate for a scheme or just to get around reporting. I think however, where reporting really doesn't make sense, as we said in the past, there is some options for you to start to think about as the removal of special purpose approaches. So I just wanted to throw some ideas around possibilities there for you. All right, I recognise it's gone the last couple of slides. I would note that although there wasn't a lot of change coming for the current year, 30 June 28 is going to be pretty big in the accounting world. We'll have sustainability reporters reporting, those Group 3 sustainability reporters. AASB 18 will be coming in. There's some uplift requirements on auditors coming around fraud and going concern. So they're going to ask you for a lot more information around those areas. And we'll be pretty close to the removal of special purpose at that point. And I think we'll see people starting to think about early adoption. Am I in tier 3? Am I in tier 2? What does that mean? So there's a lot going on in that space. Maybe that's a slide for me, because I'm starting to look down that and feel the pressure and going, wow, 2028, there's a lot happening in there. But it will mean more work and more things for you also to consider around those periods. So you get a couple of years with not a lot of change, and then I think we're going to be back into the change agenda. Finally, I just would note that the AASB continues to research other topics. So although there's no indication of what these things will mean, I do note that AASB is doing research in relation to sustainability reporting for NFPs. Even though I said you're exempt at the moment, they're thinking about, is there an appetite? Should there be one for sustainability reporting, particularly the large NFP end? And they're also looking at service performance reporting again. What that means is you reporting on your objectives, your activities, how you measure results of those, and that forming part of, I guess, what used to be the director's report, have some sort of service performance reporting requirement for NFPs. This has been round the block a couple of times with the AASB before, but New Zealand have implemented something. And so it comes back onto the agenda because of that. So a fair way off, but there are these things, I guess, rumbling along in the background. I think that's all. If you have questions in relation to this, please don't hesitate to reach out, or Pete, Edward, or really, if you deal with anyone within the audit team, or say with Dawson, you can shoot the people any sort of questions, and they'll be able to answer, or at least put you in contact with me or the right person. So that's really it. Obviously, there wasn't any. This hasn't been specific advice, and the relevant disclaimer is there. I do note we'll put out the recording of this presentation if you want to share it with others. It will probably go up on our website sometime early next week, and the slides will also be posted out with that. So hang tight for a day or two, and then you will get that email as we get that out to you. So that's really the end of the presentation. I might just see if there's any comments. If you have to go, I realise I'm over 1 o'clock, so please just jump off, and thanks for attending. But Edward, was there any common questions or things that you think I should elaborate on any further?
Not too many questions today. I think one thing, perhaps just to get your sort of thoughts on, is some out there might, for instance, say, I really like the sound of this tier 3. Is it feasible to think that early adoption could be as early as, say, June 2027 if you're a 30 June reporter? Obviously, we don't really know, but you've obviously been keeping in track with developments as they've progressed.
Yeah. Great question. I think it would be December 26, June 27 would be the first time that I would think you'd be able to early adopt. There's really I suspect when the standard first comes out, we won't have thresholds. And so I'd be reluctant to, until we had some clear, at least indication of what the thresholds would be from Treasury, I'd be reluctant for anyone to early adopt. That being said, if you're less than 3 million and you really like the idea of getting the leases off your balance sheet and maybe the way revenue would be treated, you could start to align your accounting policies with those requirements as a special purpose reporter. And so in effect, you're adopting tier 3 to the extent that's attractive to you in those periods, and maybe even 26. Without necessarily adopting tier 3 in totality. So it's continue to use special purpose, but begin to align with those requirements. So that's probably pragmatically how I would advise organisations if they're looking at tier 3 and again, finding it attractive, which I think a lot will in reality.
And perhaps one more, get your thoughts as well. In the example of, say, I'm a large charity. I'm preparing separate financial statements and not consolidating, and perhaps I have some known related entities. Maybe I don't have any transactions with them, so I haven't needed to do disclosures. How concerned would I need to be that potentially I could get forced into consolidation under tier 2? And what would you do to prepare?
Yeah, so I think it is over the next year or so, I think it is really important for organisations to understand from an accounting standards perspective around control, as opposed to pragmatically or practically what you're doing at the moment. We've certainly got clients where we think under accounting standards, you might be, or it's likely that you would meet the tests of control, but in reality, they actually have not a lot to do with them. So that's a really interesting, I guess, conundrum. So we would think over the next year or so, you start to think about those relationships. It really comes back to an ability or power to control. And it comes, like I said, the common examples, it comes through either some equivalent of the shareholder rights or member rights or some sort of right around appointment of board, and control and ability to control majority of that. That is the most typical requirements. Also, that gets really murky when there's trusts involved and trustees and those sort of things. So I think it's just a matter of thinking about those things where this could potentially apply, working out exactly what you've got in this, I'll call it a structure, and then thinking through the requirements of the standard. Like I said, they're complex, and it is something that, particularly if you're our client, but I also do a bit of technical work where we don't do the audit, for example, where we're doing advice around some of those complex structures, particularly around trusts, where it's not as straightforward as the standard would make out. So I think it's understand those what you've got, then think about the requirements, and then you've got time. If you do determine that actually we think we're in control, or maybe, okay, what could you do if it just doesn't make sense for you? So it's really understanding those governing documents as the first step, and that's what I would do.
Thanks.
All right. If there's no other questions, again, thanks very much for joining us. All the best as you work through year end and you start to get pesky auditors come and visit you, and all those things. But otherwise, thanks very much for attending. I look forward to seeing a number of you in person again in the not too distant future, and enjoy